Welcome to the February 5th, 2018 Advance Report from McGowanGroup Asset Management clients and NetWorthRadio.com listeners. There were 3 days this week, the Dow down triple digits, falling significantly below 26,000. We're about to put that in context, but for North Texas shareholders of Dr. Pepper, they had a fabulous week. So Dr. Pepper came public after being taken private. Dr. Pepper Snapple back in 2008. You can see the lows there. This week, boom, a 25% gain on Monday as Keurig announced they're going to combine the companies, and it gives shareholders of Dr. Pepper Snapple about the equivalent of $120 a share. They had closed the week before at $95, and you can see all the way back here below $20 in the crisis. Congratulations to the long-term shareholders in Plano-based Dr. Pepper Snapple. Putting the Dow in context, you can see the gap here, here, and here. This weekend's long play program, NetWorthRadio.com, Alex Tolene has a very important graph about the institutional money flows associated with the declines on Monday, Tuesday, and at the end of the week, the Dow falling significantly below 26,000. To put that in context, though, the first visit to 26,000 was just not that long ago. This is January and December. So really, you're looking at giving back about 1,000 Dow points or a little bit more. A much overdue correction. Does it mean things have changed? Well, it certainly does, but its implications for portfolios, that's going to require a little bit more time than we have here. So go to NetWorthRadio.com. All right, Fed announces that they're not going to change interest rates, and this was just since they started raising rates from near zero all the way to the 1.5% upper bound. 1.25 is the lower bound. They left that unchanged. What happened on interest rates? So you can see the 30-year Treasury rising back just above 3%. The 10-year Treasury and the 2-year Treasury, significant strategy additions, especially on the shorter end of the yield curve. Those details will be available at NetWorthRadio.com. Here, look at the first time that we topped the 3%, or the last time. We went to 3.2% after the election. So in this case, what you're seeing is not that abnormal, and the general downtrend was broken this week. What does it mean? Fed funds rate went up. Long rates are very low compared to where the Fed funds rate is. That flattening of the yield curve leads to a significant strategy discussion. This is the high yield index. We got intelligence this week that the default rate in B-rated corporates, which usually runs 2 to 5%, 10% in a recession, that default rate is about 1%. What does it mean? Well, you can see the risks of high yield. There's the credit market freeze. There's the crisis. Always there's value at risk of loss here. But what's interesting, par is 100. That's where a bond matures, 100%. A 1% default rate would imply a potential 98, 99 on this index, which closed the week just below 87. Important fixed income strategy implications will be in this weekend's program. One more chart. This is the Volatility Index. Notice the volatility coming up, but we're still nowhere near the levels of 2015. There could be a settling back down, but the big rally in equity, the big relentless rally, was dented this week. Tune in to NetWorthRadio.com for the details. I'm Spencer McGowan, President, McGowan Group Asset Management.